Good morning. I hope you're all very well today. Welcome to the launch of the 15th Sygnia ETF. That's our 15th ETF, quite phenomenal, extending the range of the ETFs that we currently have. And today we're going to be talking about the Sygnia Sustainable Economy ETF, a broad-based climate change fund that invests in innovative companies that are providing tools to create a better tomorrow. And this ESG fund complements our existing global ESG fund, the Sygnia Itrix S&P Global 1200 ESG fund. That one works on negative screening. This new one works on positive screens. We'll take you through exactly how the fund works, but there will be Q&A afterwards. So if you have any questions, please post them. And there's also the JSC will be listing a 2-minute video. So if you get bored of me and you just want the quick 2-minute version, that's available on the JSC website at 12 o'clock today. Okay, so let's make a start. Sustainability forms part of Sygnia's 4 global themes. We have sustainability, disruptive technology, which includes 4th IR, as you all know, and the FANG funds, aging populations, which includes our healthcare funds, our OSE fund, and emerging middle class, which includes emerging markets and our China fund. Growth themes are vital for an investment portfolio to survive in a low growth, high volatility world. And we firmly believe that global growth is going to continue to be low, and it continues to face numerous headwinds. The 4 big Ds, which are causing us all to be quite disappointed with our returns, are as follows. The first is debt. Debt has risen to new all-time highs. Every time the world gets into any sort of problem, debt is just rolled out, can is kicked down the road. We take on more debt to try and claw our way out of the hole that we created. And unfortunately, having excess debt or too much debt impacts growth, partly because it steals spend away from research and development. Partly it's that interest payments steal spend away from earnings. So short-term earnings are depleted, and long-term earnings through R&D are also depleted. But most importantly, it reduces investor confidence, because high gearing or high leverage means that everything's incredibly finely balanced. Any sort of global wobble that happens results in escalated volatility in the markets. And so people don't want to invest. People are scared and they stay defensive. So global debt is certainly something that has been constraining growth for the last 14 years since the great financial crisis. We've had the slowest recovery in history. And that's because debt keeps growing and it's unlikely to stop. If we look at how Japan, that's again our framework for how things have worked out in terms of quantitative easing and debt, and how they've survived in a low growth world as a result of aging demographics and too much debt. Well, their debt just keeps on escalating and has continued to escalate over the last 30 years. So global debt remains high and is only going to get higher. Aging demographics is the second big headwind. Again, that's Japan hit that headwind first about 20 years ago when their working population started to shrink. So potential growth or potential GDP growth is made up of 2 parts. On the one hand, you've got the number of people who are working. On the other hand, you've got how well they're working or how productively they're working. So productivity growth and labor growth. When your labor force starts to shrink because of an aging population, well, your GDP shrinks as well. In fact, when you've got shrinking labor forces, like we currently do in Japan and Europe, well, then productivity is the only thing that you have to try and break even and have just zero GDP growth, particularly in real terms. And that's what we've seen in Japan. In real terms, their GDP has been close to zero over the last 30 years. And that is increasingly what we're seeing in Europe and US, and even in China to some extent. Yes, their growth is much higher, but their growth is also coming off as their demographics age. So aging demographics is certainly a big headwind to growth. The third is decarbonization. This is a new D, and it's a result of basically ESG and the world trying to enforce that the costs are properly associated with the utilization of different resources. So in the past, people were able to mine or farm or manufacture without worrying about the costs of polluting or destroying the environment. And that decarbonization, that whole move to actually make people responsible for the impact on the world and on the climate, that's certainly going to come at a cost to growth. First of all, it'll come at a cost to earnings in the short term, and longer term, as more and more stringent regulations are put in place, it'll further constrain earnings of old technology companies. Obviously, it's a boom to others. And lastly, the fourth D is deglobalization. And that's also a relatively new one that started in 2020 with COVID, and then has been accelerated now in 2022 with the Russia-Ukraine war. And basically, it refers to supply chain security. COVID was the first thing to disrupt supply chains, as various ports and countries that supplied industry around the world were shut down, particularly China. And that's continued to some extent with China's zero COVID policy. And then more recently with Russia and Ukraine, it's obviously led to an energy crisis, but as well a food crisis, as Ukraine exports a large amount of wheat and sunflower oil. So companies now, if you look at the charts at the bottom, they are talking about deglobalization. They're talking about relocating their supply chains. It doesn't mean they will, it doesn't mean they have yet, but they're worried about supply chain security more than they are about a supply chain efficiency. So again, that impacts margins, that impacts growth as people start to build in redundancies into their process at the cost of margin. And that is also passed on to consumers where they can, and that leads to inflation. So definitely a big headwind to growth. So when you're looking at growth slowing down, as we have over the last decade, and it's going to continue at least for the next decade as a result of these 4 Ds, well, you have to find ways to invest where growth is still going to be around. And that leads us to themes. Our 4 themes that we have are all still going to grow revenue and grow margins despite the world itself slowing down. So even though as a whole, the world might have slower growth, as a whole, companies might have low earnings, there are definitely pockets that will still survive these headwinds. So if you look at debt level being in historic highs, I mean, that's global growth as it slows down. That was what led us to invest in disruptive technology stocks, 4R and FANG, where you're looking for companies that will grow their market share and find new markets to grow into, even as growth is slowing. Aging demographics, so that's certainly a headwind to growth, but at the same time, aging demographics leads to increased healthcare spend. And that's why we've launched our healthcare theme, healthcare innovation, which will benefit from aging populations and from increased wealth across those populations. Decarbonization, well, yes, that is definitely a headwind to traditional and old businesses, brown businesses, if you want to call it, but certainly green businesses or sustainable businesses are going to have massive tailwinds as a result. So what we've tried to do is use each of these 4 headwinds that are going to impact traditional businesses and impact traditional growth, and look for ways of harnessing what is available. And deglobalization, yes, that's certainly going to impact global growth and make global growth less efficient. But at the same time, if we can pick various emerging markets that are within, so that their local growth is going to be supported as their own middle class emerges. And that's what we're seeing in India and China. Well, then those countries will be supported by local growth and won't need to be as supported by global growth. And certainly is what China is trying to do right now, or they have been for actually the last decade. They've been trying to fine-tune the economy to be less dependent on global growth and support the local consumer. So we've got 4 headwinds to global growth. We've got four themes that we believe are going to work well and actually take that headwind and create it into a tailwind for investing. And today we're going to be talking about the Sygnia Sustainable Economy ETF, which fits into our sustainable theme, and we believe will face increasing tailwinds going forward. So it's not just that we believe in the theme over the long term. In the short term, the sustainable theme is being accelerated by the war in Russia and the Ukraine, because it's led to 2 big things. One, it's led to governments, particularly in the EU, looking for energy security. So you've got vast amounts of government R&D spending that is going to lead to huge innovations around renewables. Not only innovations, but just increased demand as governments try and achieve energy security or energy neutrality. At the same time, it's impacting energy prices. As you can see by the chart on the right, you can see the oil and natural gas prices, which are up more than double over the last year. And that's leading to businesses and consumers trying to reduce their dependence on natural gas and oil and move to solar and various other alternatives. But even before Russia invaded the Ukraine and we had this additional support, clean power and clean technology investment was estimated to be $131 trillion by Global X. Now it's going to be far higher than that. So you can see here the chart about individuals. This shows that surging energy costs are expected to drive record investment into solar installations in Europe. And residential solar is expected to grow by 42% this year alone in Europe. And European solar is expected to reach 100 gigawatts by 2030. That's quite an amazing increase. You can see here the chart on the right, just the exponential increase that's being seen as high prices drive residential and industrial users into solar. It's not just high prices that are driving the move into renewables, but legislation is also doing so. There is increasing legislation in Europe, but at the same time, the US is also driving legislation. You can see here again the chart on the right. The blue chart was the original estimation for US solar installations, and the green is the updated past Biden's Inflation Reduction Act, which will allocate $369 billion towards incentivizing renewable energy development. So again, another huge tailwind to renewable energy. Now, it's not just all about solar. Yes, solar is certainly the cheapest and easiest to install and the quickest. But one of the big issues with solar and wind farms is that they're not a reliable or base source of energy. They only generate power when there's wind or when there's sunshine. And as a result, new storage techniques are required. And hydrogen definitely seems to be the one that's going to be the winner in this place. Big hydrogen investments are on the way. 85% of the recent Bloomberg European New Energy Forum said that they're looking to invest in hydrogen over the plus size 100 megawatt electrolyzers, and they're going to do so in the next 3 years. It's 85% of the people there. South32's CEO, Graham Kerr, expects that hydrogen could replace coking coal in the next 2 decades. Hydrogen and all the infrastructure that supports hydrogen is certainly something that is going to see a lot of growth as a result of these accelerated demand into renewables, particularly solar and wind. So that brings me to the actual fund itself. I'll talk about how the Sygnia Sustainable Economy ETF invests and what it does. Basically, we've taken 2 years to design this fund. We started designing it in partnership with Kensho in the US over 2 years ago, before the recent acceleration in renewables, before the Russia-Ukraine war, before increased legislation, just because long term we think that this is a theme that is vital to investing and is going to see huge tailwinds. But it's not just a technology ETF. It's about the entire economy. And we've broken down the investment into the 4 pillars, the three parts of the economy, the primary, secondary, and tertiary. And we've added a 4th one, which is infrastructure, which is basically energy, as it has a large allocation to energy. And the fund is diversified across 300 shares, with the bulk being in industrial and renewable energy companies. So although we're looking for innovative companies that are going to be building the tools, we're not necessarily looking at technology companies. And I think it's quite important to differentiate between the technology as a tool as opposed to technology as a sector. And this is more applied technology to try and achieve various services, products, and tools to build a better tomorrow, more sustainable tomorrow. So starting off with the first sector, which is sustainable infrastructure. And I've already spoken about renewables getting a boost, but you can see that the chart on the right, which is before, this is the 2021 IEE forecast. And even before the recent Russia-Ukraine war, renewables were expected to increase by 50% over the next few years. And by 2026, back then, it was expected to account for 40% of global electricity production, a huge, huge increase. But as I mentioned, you can see that the base load of renewables from 1990s has always been hydropower. Hydropower is the most efficient because it's a sustainable source of storage as well as electricity production. I.e., you can have it as a base load. You can choose when you want to generate the power, and you can also pump water back up into your dam and use it as a battery. So that's certainly the most efficient method of renewable power. And it is going to grow over the future, but it's really constrained by the physical geography that is around. You have to look for rivers that can be dammed for rainfall areas, and there's only so much that can be done. So if you look at the big increases there, it's certainly in the green, which is onshore wind, and solar, which is the yellow. But as I mentioned, solar and wind, although they are cheap and they are quick to install, they require storage. And the biggest cost, in fact, turns out to be the storage. So that's why, the first example I've got of innovative companies that we're really are excited about in the Sustainable Economy ETF is Plug Power. And Plug Power supports the entire hydrogen infrastructure. They create hydrogen, they store hydrogen, they distribute hydrogen, they assist companies by integrating hydrogen tanks into vehicles. So across the entire value chain. And hydrogen, while it is certainly behind in development compared to electric vehicles, the potential is far bigger, particularly in heavy vehicles, in buses, public transport, trucks. But even in normal cars, Toyota already has a fleet of hydrogen vehicles in California that they're test driving. And a hydrogen vehicle is an electric vehicle. It's just got a much better battery. It's more efficient battery. It's got a much longer range, and it's 100% green, as opposed to electric vehicles, which are constrained by their range. When you charge, you're probably charging using coal power, and it doesn't actually convert that power as efficiently as hydrogen does. So while hydrogen is certainly behind, and the development of EVs, it's definitely got the potential to replace. In the future, instead of going to the fuel station to put in diesel or petrol, you're likely to be putting hydrogen into a vehicle for a much more efficient green and longer ranged transport. Anglo American is already, it's made history by producing the world's first large-scale mining truck that's produced by that's run on hydrogen. So again, it's the entire spectrum, that entire hydrogen network. They've got solar plants that help with drive an electrolyzer, which help create the hydrogen. They then distribute that hydrogen to their vehicles, and then inside the vehicles there's a catalyst which produces electricity, which drives the electric engine, and then water as a byproduct. So the entire chain is purely green and running some of the biggest mining trucks in the world. Very exciting that Anglo American was the first to do that. I have spoken a lot about renewables. I mean, that is certainly the most exciting thing about the infrastructure segment of this fund. But it goes beyond that. I mean, this segment is all about combining physical infrastructure with smart and clean technologies. So it's all about the smart grid, smart homes, smart buildings, using electricity far more efficiently, connecting it to the Internet of Things, and then smart transportation, as well as as the one example I gave, which is the hydrogen infrastructure. It's generally in the entire autonomous infrastructure, so electric vehicles, charging points, hydrogen stations, commercial drone deliveries, and even artificial traffic routing. So any infrastructure assets that can make the world a cleaner, more efficient place through the use of technology. At the moment, this segment, sustainable infrastructure, has got the largest weight. It does vary over time, but right now this has the largest weight of the four in the fund. The second segment is sustainable agriculture, and here it's all about doing everything better to save water and to save the planet. The OECD estimates that 2/3 of the world population may be in a state of water stress by 2025. That's nearly 2 years away. And there's certainly water scarcity is a big issue. And as climate change evolves weather patterns, that is going to become a bigger and bigger issue. Not only is there less water, but any rainfall that does fall is going to be falling in different places to where it used to fall. And that's going to create all sorts of problems. Energy demand will also increase water use by 85%, according to the UN. And definitely the Russia-Ukraine war has accelerated this, as new alternatives for energy are sourced. More importantly, an ever-expanding world population, the need to curb climate change, and increasingly health-conscious consumers requires us to do things from an agriculture perspective in a better way. So Nutrien is the first example in the fund that is very exciting. And they sell technology to farmers to try and, or the technology that can assist with enhancing output, reducing waste, reducing water usage. And that spans a broad spectrum, from agricultural drones to global satellites, robotics, autonomous vehicles, blockchain technologies, anything that can assist in making it the agriculture and farming sector more efficient through the use of technology. The other example in this sector is protein replacements. And here we've got Beyond Meat. Beyond Meat uses 99% less water than traditional meat, and uses 93% less land than traditional meat, and produces 90% less greenhouse gases compared to traditional meat. I mean, that's a vast difference, and certainly helps the world become a more sustainable place. And yes, people might not want to try Beyond Meat. I certainly, as a vegetarian, can't really taste the difference, but I'm not a meat expert, but it definitely makes an enormous difference. And companies are getting the meat replacements closer and closer and closer to the existing products from a taste perspective and a nutrient perspective, at the same time using 90% less greenhouse gases, 90% less water, 90% less land, and that has a huge impact on the world and making the world a better place tomorrow. The other exciting example is Valmont Industries. They pioneered an irrigation technology that boosts water absorption rates by 85 to 90%. Again, can you imagine if all the irrigation in the world suddenly used only 1/10 of the water it was using? Huge ability to then increase the scope of the food that we are producing, but also reduce the impact on the environment, reduce the impact on the climate, and make sure that the world is still, well, at least the ecosystems are sustainable and still around for our children and grandchildren. The third sector of the fund is manufacturing, or the secondary industry as it's known. And here the big change really is the rise of robotics. And you can see, if you look at the chart there, the huge increase in robotics that is expected over the next 2 years. And that's driven by a number of things. Firstly, storing wages. The US and EU use nearly 1/3 of the robots that is used in Korea, and there's huge scope to increase robot density, and that's going to be driven particularly in the US and Europe by wages, which, as we all know right now, inflation is skyrocketing, particularly in the lower end of the employment sector, and that is the easiest to replace with robots. But robots aren't just replacing the lower end. The ability of robots is also increasing exponentially through the use of machine learning, through the use of light detection and ranging, or LiDAR, through the use of 3D machine vision. The cost of robots is dropping rapidly. The ability of robots is increasing rapidly. The need for robots is there. And certainly, as I said, the density or the usage of robots is in the US and EU is lagging the rest of the world, particularly Japan and Korea. And that is certainly going to be a tool that many companies look to use going forward to reduce pollution, to make themselves more efficient. So sustainable manufacturing is about Industry 4.0. It's about the smart factory, and it's again about using technology to improve production processes, using technology to reduce waste, using technology to reduce pollution. And using technology to make a more efficient process, and mostly the robotics, but there's also 3D printing, advanced new materials, nanotechnologies, and biotechnologies. The example I mentioned there is Alloy, which is a company that we visited, and they are coming up with advanced new materials to support the 3D printing industry. So when you 3D print something, the traditional ways of producing components is mold based, and that the metal is melted down, it's put in a mold, it's cooled, and you just have one heat exposure on the product. 3D printing is thousands of layers of material, and each time a new layer is put down, it heats up the previous layer. So you've got 1,000 points of heating and cooling, which leads to massive fractures and deficiencies in existing metals if you use it in that technology. So alloys companies come in with new metals and new metal composites to work in a 3D printing environment where those metals have to sustain melting and falling below the melting point thousands of times. So the entire again, infrastructure and supply chain has to change to support 3D printing and Industry 4.0 and the smart factory. Some examples of companies that are heavily invested in this space are Boeing, Raytheon Technologies, again, leaders in the front when it comes to robotics and automation and advanced new materials. And finally, the fourth sector is society, building a sustainable society. And here we're really talking about the metaverse. We're all well aware of what happened during COVID. The world was locked down. And although that had a number of detrimental impacts on society and on profitability and on industry as a whole, the environment was one area that did benefit. People were locked down, they weren't able to travel as much, and certainly pollution from travel decreased. Now lockdowns have mostly been removed, but it's become a way of life. Certainly the metaverse has become a way of life. Enterprise collaboration frameworks like Zoom have become a way of life. Yes, we are reverting back to normal things. Travel has certainly increased, but I think the metaverse is something that is here to stay and here to grow. The metaverse it enables people to collaborate and communicate online, and it's about augmenting reality with an extended reality. And Bloomberg projects the metaverse market may reach nearly $1 trillion in the next 2 years. Other examples besides Zoom, we've got digital communities. Here, the two biggest ones that are trying to build virtual worlds are Microsoft and Facebook, or now known as Meta. But real estate is also something that is exciting, with a number of new virtual worlds that are being created, and infrastructure, so real estate that's being sold, and real estate being sold for up to or over $500,000. Warner Music recently bought real estate to host concerts. Very exciting. Brands also teaming up with social game developers. Fortnite and Warcraft are two that are selling space, real estate, and branding of clothing and products inside their games as the real world and the extended realities merge into one. There's also infrastructure suppliers like NVIDIA, so graphic chips. Virtual reality headsets are expected to surpass 34 million, and Oculus is a big one there that is in the fund. And then there's Web 3.0, which Google is investing heavily in to support, which will allow the use of composable smart contracts, programmable blockchains that will allow rapid increase in innovation in entrepreneurship through a decentralized internet. So lots of exciting change that's happening in this fourth segment, the metaverse, where we can build a society that is more online and has a smaller carbon footprint and allows collaboration digitally. Some very, very exciting companies in this sector in particular. So just to recap, why are we excited about the Sygnia Sustainable Economy ETF? Well, it is a perfect marriage of world-changing innovation and radical sustainability. It's also an industry first. This is unique to Sygnia. It was designed over the last 2 years between Sygnia and Kensho. The index has been launched, so that Sygnia is the only ETF that is tracking the index. It's only available in South Africa as a Sygnia ETF, and it has incredibly exciting potential. It's a broad, focused climate change fighting fund, and is certainly going to assist with driving the green revolution. Not only is it going to assist with driving the green revolution, but right now it's going to see huge tailwinds from accelerated government support in terms of looking for energy security, and industrial and consumer support as skyrocketing energy prices force people to look for alternatives. So the biggest winner of renewable energy, or renewable energy is the biggest winner of the latest crisis because of high prices, which is forcing people to change a lot sooner than they would have, and and from a government perspective because of the search of energy security. And then as a small microcosm, we've got Eskom helping. They're also helping drive everyone towards solar and away from the grid. I don't think that's on purpose. The fund invests in a superbly diversified portfolio of over 300 industrial and renewable energy stocks, so very nicely diversified across all the sectors of the economy, across 300 stocks, so no large exposures, more of an industrial focus than a technology focus. So again, not as dependent on what's happening with interest rates, and for the low management fee of only 0.5%. So that's very, very exciting that you get all of this for only 0.5% fee. Perfect. That's a wrap. Thank you. Let me see what questions are there. Perrin asks, will this ETF pay dividends, and is there a view of the dividend yield? That's a great question. I actually can't tell you what the dividend yield is right now, but the fund certainly will pay dividends. It's not a value fund by any stretch of the imagination. We certainly don't target dividends or high-paying dividends to get into the fund. The fund is very much climate change, sustainability focused. So here it's investing in companies that are benefiting from that growth. Certainly those companies are all relatively cash flush right now, or a large number of them are, due to what's happening in the world. But the fund doesn't target a dividend yield as such. That would be secondary to the design of the product. Perrin also asks, how has the ETF performed historically? There is a backtest of the ETF. I can, if you email admin at Sygnia today, I can ask someone to send you that backtest. But backtests are certainly not representative of future performance. Certainly, the demand for renewables and sustainability has changed dramatically over the last year. In fact, as legislation has changed, as the US has gone to a democratic-led government, so as we've had the war in Russia and Ukraine, so all of that is going to lead to an acceleration in terms of demand of the sector. So I wouldn't look at the backtest too aggressively. Ben points out that hydrogen can also be obtained from natural gas, and that is spot on. And until the recent energy crisis, dirty hydrogen, which was from natural gas, was certainly cheaper than green hydrogen, which comes from splitting or withdrawing hydrogen from the air. And post the Russia-Ukraine crisis, the spike in energy prices has now made green hydrogen cheaper than dirty hydrogen, and that's what's leading to an acceleration in the green hydrogen infrastructure. And hydrogen is not just a mean of transporting; it's also a mean of storage. So yes, you're right. While electrical wires can transport, they can't store. And the big thing with water, sorry, not water, big issue with wind and solar is that they are not generating stable power, and they can't generate power when you need it. So storage is very, very important, and hydrogen is looking like the most efficient means of storing it, as opposed to lithium batteries, which have a terrible impact on the environment. They're very hard to recycle, very expensive to recycle, and we are looking for alternatives. There are other alternatives. There are companies looking at alternatives, and there's salt batteries, a huge, that's something that can't be done on a micro scale, so you won't find a vehicle with a salt battery inside it, but certainly for massive plants that can store solar and wind power, that is an alternative that's being looked at. So there are other avenues of storage that are out there and being researched. Hydrogen is just one of them, but it's probably the closest to being rolled out relative to the other technologies. Andre asked, when can we start investing in this new fund? It listed today. So it's currently, there are bids and offers on the JSE. I have checked before I joined this webinar. The market maker has got bids and offers. So if you want to get involved, it's available today on the JSE. Thomas, that's a good point. I mean, ESG has a lot of issues. ESG is certainly not the answer, not the end point. And I think that's why we focus this fund more on sustainability than ESG. The issues with ESG is that you've got competing drivers. Certainly governance is something that good governance is something that is vital and it shouldn't even be mentioned. It should just be there. Governance should be something that is embedded into any investment instrument, debt and equity. So the G is kind of superfluous. So then it comes down to E and S, environment and social. And here, different countries at different stages of development and different levels of unemployment have competing drivers, competing arguments. So, in South Africa, for example, it may be worthwhile building a coal mine because it's creating employment, and that's in the social side is more important than environmental side. In Europe, that may not be the case, or certainly wasn't until beginning of this year. So ESG itself has a number of complications. That's the first, is how do you balance E with S. The second complication is how do you score these companies? Do you say, okay, fine, a company that doesn't pollute is good, and a company that doesn't generate coal is bad, and a company that uses solar power is good? Or do you try and encourage companies to change? So do you say, okay, well, a company that uses coal but has a 10-year plan to move to renewable energy, and each year is ahead of its target to become green, surely you should support those companies that are changing and becoming better companies. So do you rank companies on the absolute scores, or do you rank them on the changing scores? So all of that leads to a number of different ranking systems, a number of different scales. If you look at the various ESG indices that are out there, they all use different methods. They all have different answers. They all have different constituents, and it's all quite difficult. Yes, ESG is good, but we want the world to be more cognizant of climate change. We want the world to do things where the cost, the environmental cost, or the cost in terms of cruelty to animals is all included in the final product. So that, the aim is good. And we want social initiatives that look after local communities. And so there are a lot of positive goals from ESG. How those goals met is something that hasn't been agreed upon. And when it is agreed upon, then there's greenwashing, and there are a number of issues. So we're doing the best we can within that complicated framework. The global S&P 1200 global ESG fund uses negative screening. So there we just cut out, we don't invest in companies that have poor scores as determined by S&P. This fund is very much based on positive screening, and looks at products that are going to make the products and services that are going to make the world a better place. At the same time, to come back to your question, Thomas, it's not just about products. So we look at sectors that are creating great products and great services to make a better tomorrow, but then we overlay an ESG screen on those products. So if there is a company that is building virtual reality headsets, which is great for the metaverse and reducing our carbon footprint, but they are polluting the environment, or they have no diversity in terms of their board and employees, then that company could be excluded, or certainly can be downweighted based on its ESG score. So we combine the positive and negative screens to try and get an overall fund that takes into consideration everything. Positive screening, negative screening, ranking, and companies' ability to improve those ranks. It's but there's no perfect answer to ESG, so I'm happy to accept exceed that point. And which brings me to my next question, which is energy in Africa is limited, so how are we going to manage migration to a sustainable society? That's a great question. It comes down to the point of managing E and S, and that's why we prefer to focus on sustainability, because in some societies, to be sustainable, it's more important to focus on the S than it is the E. To some extent, then we also have to rely on support, which we are seeing. Right now, there's support from Europe to South Africa in particular to help Eskom move away from coal into green power due to the loans that they are giving us. But yes, there's again a very, very delicate balance between E and S. Elodie asks, are there any similarities between the Sustainable Economy ETF and the Global 1200 ETF? I notice the top 10 holdings are totally different. Yes, they are totally different funds. Well, they're both global equity ETFs. So I think that's important to start with. But then the Global 1200 ESG takes the S&P 1200 global index as a starting point, which is effectively, I'm sure people might be more comfortable with the MSCI All Country World Index. So it's the S&P's version of the MSCI All Country World Index. So it's the top 1,200 companies by market cap around the world, including emerging markets. There's about a 7% exposure to emerging markets. And then it has a negative screen. So you start with 1,200 companies and you exclude companies that have poor ESG scores, and you get down to about 900 companies, but very well diversified across the world. So it's invested in emerging markets in Europe, in Japan, in the US. And it includes, dirty industries and old industries, but only ones with decent and improving ESG scores. The Sustainable Economy ETF, on the other hand, is much more focused on companies that are using new technologies to create a positive impact on the environment. And then we have a ESG score, negative score, which then removes that. So you're going to look at, instead of 1,200 or 900 companies, you're looking at 300 companies. Companies tend to be more small cap. They're newer companies that are coming up with new solutions and new technologies. There are some large existing companies that are also coming up with new concepts and new ideas, but there's a lot of smaller cap companies. So it's got a smaller cap bias compared to Global 1200. And it's also got slightly more US focus than Global 1200, because there are more solutions coming out of the US right now than the rest of the world. So those are your differences. I'd say that the Global 1200 is much more diversified, and with 900 stocks around the world and more larger cap. Sustainable Economy is much more focused on industries that are improving climate change, generally slightly smaller companies, fewer companies, and much more focused. And so certainly will benefit from that theme. So another way of putting that, to come back to our nomenclature, is that the Global 1200 ESG ETF is a core ETF. It's cheaper, it's well diversified, still has an ESG focus, but it's your primary focus is diversification at low cost. You get exposure to the entire world. So it's your one-stop shop for global investing. The Sustainable Economy ETF is one of our themes. It's more focused. It's slightly more expensive at 50 basis points, and it's focusing on the sustainable theme from a proactive and positive way. Thank you, Brian. Good point. Ravi asks, I have a stockbroker account. Can I buy through a stockbroker? Yes. So like all our existing 15 ETFs, the new one which launched today is available through your stockbroker. There are an office on the screen, so you should be able to buy it through your stockbroker right now. Akbar asks, how many of the companies in the fund are actually profitable and paying dividends rather than startups with high PEs? Thinking 1999 bubble. I think that's a fantastic question. And I'll answer that in two ways. One, the fund, if you look at what its holdings, are the cheapest it's been since the back test goes back, from price to book and price to sales basis. The second is because it's got a more industrial and energy focus compared to fourth industrial revolution, for example, it is definitely cheaper. It's got lower PEs and higher dividend yields than the fourth industrial revolution fund. However, it is still, there are certainly some growth companies in there, and it's certainly more expensive than a well-diversified core portfolio. Henry asked which specific resources commodities were the main beneficiaries of the Sustainable Economy Fund. So this fund doesn't actually invest directly into resources. So there's no platinum or lithium or copper. It just invests in companies that are going to benefit from this sustainable revolution. When it comes to commodities are much harder to invest in. You have to worry about investing in futures, which have rolls and backwardation and other issues. But in terms of the biggest beneficiary from certainly decarbonization is copper, as electric vehicles and moving to diversified energy sources is going to lead to a huge demand for copper, aluminium as well, lithium and associated new technologies around battery usage are some of the big ones. Uranium as well to a small extent, as the demand for nuclear increases. The fund launched today. Ronnie asked, the fund is available on easy equities. It should be. It definitely should be available on easy equities. It is listed on the JSE, so it should be available on easy equities. I don't know if it actually is, but it should be. In terms of minimum investment amounts, that there is no minimum investment amount. You buy through your broker, so it would be dependent on any minimums that your broker might have. Differences to fourth IR, I think I have answered that. The fund, the launch size of the fund is about 115 million rand. Anton asks, what's your opinion on rebalancing a fourth industrial revolution fund into this fund? That's a very interesting question. The fourth industrial revolution fund does have an exposure to some of the funds that are some of the companies in this fund. So fourth industrial revolution certainly has exposure to renewables, has exposure to metaverse, has exposure to the companies that are fighting climate change, but just for a far more diluted manner. So you do get some of this exposure with fourth IR, but this is a more concentrated view on sustainability, and also more of an industrial and an energy focus, less of a tech focus. But in terms of rebalancing, I like both. I would buy both, certainly at these levels. Yes, to answer Dominic and Darren, there's an overlap. Some of these companies do end up in the fourth industrial revolution fund. I can't give you that exact overlap offhand, but there will be a small overlap as some of them. And it was developed with Kensho. It does use some of their filters, and some of the companies will be in both. Andre asks, can we invest in the Sygnia Itrix Sustainable Economy ETF via the Sygnia portal? We should be able to. That should be available from today. So I will also follow up and confirm on that. But yes, that should be possible. Sorry, some good points being mentioned here. So go through them. You can, Louise asked if you can purchase the Sustainable ETF as part of a tax-free savings account. Yes, you certainly can. Franca points out that yes, there are negatives to robotics in terms of unemployment, and that's certainly yes. Again, it's balancing the sustainable with climate change, and I think each country and economy will tackle that differently. Certainly, there are some countries around the world who have too much employment right now. They're above 100% employment, and that's leading to all sorts of inflation, which is not sustainable. So they can achieve more sustainable employment by using robotics. Tom asks if Sygnia can look to putting together a private equity portfolio. Tom, we do have the Sygnia Oxford Sciences Enterprises Fund, which is venture capital private equity, and that is open for investment. And that is also focusing on, it's got a particular focus on healthcare at the moment, but they are looking to broaden that into other avenues, particularly technologies such as quantum computing is one of the new streams they're looking to add. Yes, Hanu asked, will Sygnia allocate a portion of the skeleton range as offshore equity to this fund? Yes, so we have allocated all our global equity funds, or we will be allocating all our global equity funds allocation to this theme, like we do all our themes. So the signature range, the skeleton range, the CPI range, the skeleton balance range will all have an allocation to the sustainable ETF. They all have already have an exposure to the S&P 1200 global ESG ETF, and they will be also getting an allocation to this theme, as we like to keep all our global balance funds allocated to all our themes. And we think that's the best way to achieve decent long-term returns. Darren asks how we investigate and research new companies to invest in. Darren, that's done in collaboration with Kensho, same as the Fourth Industrial Revolution Fund. And we're constantly looking for new companies and new sectors, I suppose, is more important, that are benefiting from the renewable demand. Tom points out, just if everyone wants to know, the JSE code is SIG-SE. So if anyone's looking for it or have an issue with your brokers, SYG-SE is the code on the JSE. And that's it for all the questions. So we are done. Thank you everybody for joining. Thanks for the great questions. I hope you have no problems investing in it or finding out about it. We're certainly very excited about this fund. It really completes our range in terms of our themes. We're very excited about our 4 themes in a low growth world that we are expecting over the next decade due to our 4 Ds and our 4 complementary themes. And you know, all our funds do invest in that. We do believe in them. We do think that they are great long-term investments and at fantastic fees. Great. Well, have a great day, everybody. Thank you very much, and I'll see you next month.